We're back with some breaking news this morning. First Republic Bank has been taken over by federal regulators and sold to JPMorgan Chase. This comes after regulators spent the weekend trying to find a buyer for the bank.
Yeah, beginning today, 84 First Republic branches will reopen under JPMorgan Chase. This makes it now the third major bank to go under in less than 2 months. The First Republic closure has now become the second largest bank failure in U.S. history, surpassing Silicon Valley Bank. For more, we're joined by Barron's reporter Megan Cassella. Megan, good morning to you. So at the time of the closure, First Republic had assets worth more than $229 billion, and that is even more than Silicon Valley, which had $209 billion at the time of its closure. So what are your takeaways here?
It's not an unfamiliar story, right? We're seeing this happen again, what we saw in March, that, depositors were spooked by some of that turmoil. They went to withdraw their money. This mid-sized bank had a large number of uninsured deposits, over $250,000. These depositors said, this isn't a too big to fail bank. I want to get my money out. We saw last week that there were signs of that happening, that First Republic had lost a huge number of its deposits. And so it was looking for outside help. We knew there was going to have to be an end to this story. And so federal regulators stepped in over the weekend. JPMorgan stepped in. They're hoping that this contains the crisis. But of course, it does spook investors. But I will say government officials, federal regulators have emphasized that they do think that this is contained to a small number of banks that were not likely to see this spread.
So, Megan, what I think is also somewhat interesting to people, maybe raising some red flags, depending on who you are, where you have your money. This was a little bit more of a consumer bank, of a normal person who might have their money there. Not necessarily as big as a Wells Fargo or a Chase, but definitely not as sort of exclusive feeling as Silicon Valley Bank. What does this mean for somebody who has their money there?
I think, so all of those depositors are going to be safe. JPMorgan has taken over. They are now JPMorgan customers. And between JPMorgan and the FDIC, the Federal Deposit Insurance Corporation, all of that money is going to be safe. But of course, it spooks people. I think that's very understandable. First Republic was a big home lender, too. And that was one of their problems, was that they had given out mortgages, doled out mortgages with really low interest rates that were losing their value as interest rates rose this year. So, of course, customers are spooked. Regulators want them to know that their money is safe. They're really hoping that by stepping in the way that they did 2 months ago, by doing that again, that it sort of curbs any further deposit flight from this bank or any similar ones. They want you to know that your money is safe. But people are looking to move to those bigger banks that maybe have more capital on hand, wouldn't be as vulnerable to a bank run.
And even for people who aren't paying close attention to financial news, hearing about one closure after another, it starts to make people worry about the future of the industry. So what do we know about that future? Are there any other potential takeovers maybe looming here?
We don't know of any at this point, but we didn't know of Silicon Valley much before it happened, right? But, what we hear over and over from bank officials, from Federal Reserve officials and others at the FDIC is that they believe that this was a pretty unique subset of the banking industry, that First Republic is sort of an extension of what happened in March rather than a new wave. And so because of that, they think that now all three of those have been contained, have sort of been stabilized and taken over, and that hopefully there aren't any other shoes to drop. The caveat to that, though, is that the Federal Reserve is continuing to hike interest rates in its fight against inflation. And while they're not trying to destabilize the banking sector, that's a side effect. It's collateral damage in a way. And so they have done, and other regulators have done everything they can to shore up the banking sector. But it's possible we do see more weakness as they continue to raise rates.
Megan, let's quickly talk, we just have a little bit of time left, but about how this happened. I know you had written the Federal Reserve's internal review of Silicon Valley Bank's collapse earlier this year places the blame at the bank's board of directors, but the Fed also blames itself. Again, that's about SVB, not what we're seeing right now. What does that mean about how this happens? And thank you for the reassurance that you just said about this potentially not necessarily happening again or with one of these banks that we've all heard of before. But if that was able to happen, what does that tell us about the industry?
It means, what the Fed in that review is really worried about is that they have sort of taken their eye off the ball, that they have deregulated over the past 5 or so years, taken steps to loosen regulations in a bid to try to help banks out a little bit. But it looks like that they maybe have gone too far. That was the Fed's takeaway. They think they need new rules to try to make sure the banks are paying more attention.
All right. Megan, thanks so much for breaking that down for us. We appreciate it.
Thanks for watching our YouTube channel. Follow today's top stories and breaking news by downloading the NBC News app.